Hi folks, welcome back to the second part of our video on bonds. Here what we're going to do is we're going to issue the bonds, as we say, between interest dates, but really what this means is that so far we assume that the issue date was the same as the bond date, but what if they're different? So instead of our bonds being issued on the same day that they're dated, and again the day that they're dated means that's the day they're available for sale to the public, or whoever's buying them. But the idea here is that even though this is the date they're dated, it's not normally the case that they're all issued on the date they're dated. They might be dated this date, but the sales may not be complete to the investors until a later date. So I'm going to assume that the sales are taking place after the bonds are actually available to be purchased, and then once they're fully subscribed or paid for, they're issued on June the 1st. So we have a bond date of January 1st, which is different than the issue date, June the 1st. They're still going to assume, as we did previously, that interest is paid at the end of December every year. Now, there's a rule. The real question is here, at the issue date, that's when we would make the entry to debit cash, credit the bond payable, and set up any unamortized premium or discount, in this case discount. But how do we know how much cash we're going to get from the investor so that the issuer, a company, can set it up? The cash proceeds that the company issuing the bonds is going to receive is going to equal to the present value at the date of issue, which is kind of what you're used to, because when you were calculating the present value of a bond, you did it assuming the issue and the bond date were the same. So you were already calculating the present value at issue date anyway. But now the issue date is June 1st, not January 1st. But these guys, when they buy the bond, they're going to be there on December 31st to collect the interest. And what we do is we say, well, whoever's there on December 31st is going to get the full amount of the interest for the year, even though the bonds were issued partway through the year. So what we do is we have the issuer or the investor pay up front any interest that's accrued from the bond date to the issue date. So we would accrue 5 months interest from January 1st to June 1st. Have the investor pay us that up front, that 5 months, and then at the end of 7 months, they get the full 12 months, which is the 5 months they've prepaid, and the 7 months that they've earned in interest because they hung in the game. They were there from June to December. So what you need to do is you need to figure out the present value at June the 1st, which I've got calculated here, and I'll show you that in a minute, plus the accrued interest for 5 months. Well, we already said in the previous part of the question that we're going to pay them interest of $15,000 at the end of December. But to determine how much of that the investor needs to give me up front, I want the piece from January to June up front from them for 5 months, because they're going to get at December 31st, when these guys are paid, they're going to get the full 12 months. So they have to prepay 5 and get the other 7 at the end of December, because that 7 months is the amount of time they've been in the game. But they're getting 12 months interest, but they've only been in the game for 7 months. So they're prepaying 5 months up front at the date of issue, and they're collecting 12 months of interest at the next interest payment date, which is December 31st. So 5/12, so 15,000, is $62.50. So when I add that to the present value at June 1st, I get $202,541. Now, before we go to the entry, let's figure out how I got that number. So what I did is I just pulled out the bond table that we did in the first part of the question. And you'll recognize at the original bond date, which we said at that time was the issue date, the present value of that bond was $196,007, and the unamortized discount was $39.93. To get to the end of the first period, which in this case was a year, we amortized some of that discount, right? We amortized $681. It was the difference between the interest payment and the interest expense. So I already know how much discount I would have amortized for the year. And I already know how much unamortized discount I have at the end of December. But what I really want to find here is the present value of the bond at June the 1st. That's how I'm going to calculate my cash proceeds at the issue date, which is different than the bond date. I need to know what this is, right? So how am I going to get that? Well, I'm just going to remove the little rectangle here and show you. I calculated $196,291. How did I get that? Well, I calculated what the unamortized discount would have been at June the 1st. All right, what would it be? Well, how much of this $39.93, which was the present value at January 1st, would I have amortized to the end of June? Well, that would be 5 months of that. So 5 months, 5 months of 681, how much I amortized, right? So if I would have amortized 681 for the whole year from January 1st to December 31st, that's what I amortized for 12 months, then this must be what I amortized for 5 months. So 5/12 of that is 284. So now, unamortized at January 1st would have been $39.93. I amortized 284 of that for the 5-month period up to the date of issue, or I would have amortized that much, right, up to the date of issue. So the unamortized discount at the date of issue is not $39.93, it's $37.09. So $200,000 less $37.09 gives me my present value. So I like to get the students setting up the table, and in this case you can see where it's very helpful. In Bond Basics, when we talked in the first video, you could see it was helpful for helping you pick off your entries and doing your calculations. Well, here it's even more helpful to you because now, from any time within the first of the month or first of the year to the end of the year, you can figure out the present value of the bond at any time in here just by allocating the discount, that you amortized for the year across the periods. All I did was allocate this discount amortized over 5 months. Subtract it from the amount that I would have had if this was my issue date to get this as the unamortized piece. So $200,000 at issue date less what would have been unamortized gives me this present value or net liability at June 1st, 2005. So that's how I got this number. Added to this, I get $202,541. So now that's the amount of cash I'm going to get. The present value at issue date plus the interest for 5 months up front, because at December 31st, they're going to get a full 12 months interest. The 5 months they've prepaid at June 1st and the 7 months they've earned in interest from June the 1st to December 31st. I now record my discount, which I showed you on the previous screen, credit my bond payable, and now as the issuer, a company, I also have to set up interest payable. That's the 5 months interest that they paid up front, right? That's that $62.50, because that's the part of the $15,000 that I got to pay them back on December 31st. So here's my entry on December 31st. So if you go up here a bit, you'll see that now I'm reducing my interest payable. Why? Because I'm paying these guys. I'm paying them $15,000. And this $15,000, this $62.50 is part of it. That's the amount that they gave me up front for the right to receive a full 12 months, right? So they get the full 12 months payment, so that's a credit by the issuer to their cash account to pay the investor. I'm going to debit the account payable because once I pay the interest, I no longer have any interest sitting in a liability, right? Now what I'm going to do is I'm going to record interest expense. But remember, I only want interest expense from the issue date. We can only record interest expense from the date the bond is issued and in the hands of investors to the end of the year. And in this case, I'm assuming it's December 31st, so it's 7 months. That's from the issue date of June the 1st to the interest payment date, December 31st. That's your 7 months. And this $15,681, you'll remember, was what we had here. That was a full amount of interest expense for the entire year, 05. I only now want it for June 1st to December 31st, which is 7 months. So therefore, if I go back here, 7 months of that is $91.47. So the discount on the bond payable you could plug, but you can also calculate it. Because you know the discount for the full year, again, we did it here. It was $681, but you only want that now for the 7 months that they were in the game, okay? And that 7 months of that $681 is $397. So that's your journal entry. So now if I asked you to prepare the statement on the balance sheet, just the bond section, in the non-current liability section, you would still have a bond payable of $200,000, but your unamortized discount would be the original unamortized discount that you booked up here. Notice it's different than in the first video when it was the full amount of 39.93 in the first video. Now it's 37.09 because we're 5 months into the year, right? Because the bonds were issued at a different date than they were dated. So I've deduct 33.12, and that's going to give me 196,688, which is exactly what I have here, and which was in your original table in Part A if you wanted to go back there. But that's the idea. Okay, so now, how much interest expense would we show in the income statement for a company for the year ended December 31st, 2005? Well, we're only going to show $91.47 in interest because that's the amount of interest from the issue date to the date of the statements. So it's $91.47, and you can see it right from this entry. So this concludes the next video in the series that introduces you to the concept of bonds being issued at dates that are different than the bond date. In the next video, we're now going to change the year end to September 30th. So we're going to demonstrate accruals again, interest accruals on bonds when the bond date and the issue date are different. So stay tuned, and thanks for listening.